In part one, I showed you how even a single dollar in a Roth IRA starts the 5-year clock for contributions. If you missed that one, it'll be linked in the description below. Today, we're flipping to the other half of the Roth story, conversions. And this is where things can really change the game, not just for you, but for your family too. Welcome back to Mark's Financial Playbook. Our team is steadily providing you with the most up-to-date strategies to help you save money, reduce taxes, and keep you up to speed on the latest legislation. My name's Mark Basil. I'm actually a financial advisor, but this channel isn't personal financial advice. It was built as an educational platform designed to give you advanced planning strategies for you to explore. What exactly is a Roth conversion? It's when you move money from a traditional IRA or a 401k or any pre-tax account into a Roth IRA. You pay tax now on the way into it, but then it grows tax-free forever, never to be taxed again. And the real decision isn't about the clock. It's about the tax rate you lock in today versus the tax rate you may face in the future, not just for you, but for your heirs. Think of it this way. Would you rather pay tax on the seed or on the harvest? Conversions let you pay tax on the seed, a smaller amount now instead of the full harvest later, when it'll likely be larger. And remember, with a traditional IRA or any of those pre-tax accounts, you actually have a silent partner, the government. They own a percentage of your retirement because they decide the tax rate now and in the future. A conversion effectively buys out your partner, so the account becomes fully yours. Let's look at a couple, both age 65. They have $60,000 in wages coming into the household, $20,000 in rental income, $10,000 from a pension, and $5,000 in dividends. From their $1 million 401k, they've decided to roll it over into a traditional IRA and convert $45,000 of it into a Roth IRA. That brings their total income to $140,000 in 2025. Now let's subtract deductions as a married couple. $30,000 standard deduction, $3,200, $1,600 each for the 65 plus deduction, and $12,000, $6,000 each for the one big beautiful bill senior bonus deduction. This brings their total deductions to $45,200. That leaves them with $94,800 of taxable income. Now look over here on the right, and here's the key. They're still inside the 12% marginal bracket. Room left in the 12% bracket, $2,150. That means they squeezed in $45,000 of Roth conversion and didn't spill over into the next bracket. This is precision planning. Let's see the impact if we bump that conversion up by just $5,000 to $50,000. Their taxable income increases to $99,800, and now they've crossed into the much higher 22% bracket. We want to avoid this. See how that room left in 12% line disappears? It's gone. That's the line you always want to keep an eye on. So what's the tax savings? At $45,000 converted inside the 12% bracket, their tax today is about $10,900. That's an effective rate of just 11.5%. If instead they waited and had to pull that same money out later at 32%, which is the projected future tax rate, the tax bill would be almost triple. That's about $9,000 in savings on this one conversion alone. And if they repeat this for 10 years, they'll move about $500,000 into the Roth, saving approximately $100,000. This isn't for everyone. If you truly believe tax rates will be lower or even the same in the future, let's say 2030, then a Roth conversion may not make sense for you. But if you believe tax rates will be higher, even by just 1%, this strategy is definitely worth exploring. Because at the end of the day, it's really not about how much you make. It's about how much you keep. So now you're getting a grasp of the Roth story. Part one was how contributions start the 5-year clock. Part two, this video, how conversions can lock in today's lower rates and protect your future for you and your family. But remember, part three, there's a few important variables to consider. Staying out of the Medicare IRA surcharge zone, because it looks back 2 years at your prior tax return. You also have to make sure you're at least 59 and a half years old to avoid penalties on those distributions from the IRAs and the 401ks. And lastly, how are you going to pay the taxes on your conversion? From the money sitting in a checking account Or will you withhold state and federal tax from your conversion? These are things we're going to cover in the next video. And as always, this video is for educational purposes only, not personal financial advice. So talk with the pro before making big moves, or let us know your situation and we'll run some scenarios for you. If this video helped in any way, consider subscribing to Mark's Financial Playbook. It's free. And comment below, would you rather pay 12% now or gamble on 32% later? Thanks for dropping by, and we'll see you in the next one.